Well, welcome to my studio here in fabulous Las Vegas. This is Dean Tenney. You're watching the YouTube channel, and we're in the Series 66 playlist. I've been trying to build out these playlists. So, the channel typically has a playlist for whatever series you're on. And after you're seven, the next leg in your testing journey is 66. And we have some narrative lectures up there. We have a practice final up there. And I'm in the middle of explicating the test specifications that come from NASA. I would highly recommend that you print this PDF, and then you can follow along with the explication. Now, the explication means, why questions, what questions you're going to encounter. It's not a lecture. I'm not going to do a futures lecture for one question. I'm just trying to point you in the right direction of things, whether it's the YouTube channel, my YouTube channel, or whether it's going to be your vendor that you're using, Kaplan or Past Perfect, or STC or Knopfman or Solomon, whatever, to make sure you're paying attention when you're using those resources and going over this stuff. As you see here, futures are one question, and futures are contracts on the underlying. And, futures are actually simpler than options in this regard. If we're going long the futures, let me get out my, I always try and put the difference. It's not like we have types here. We're just long futures or short futures. And if we're going long the futures or buying the futures, I'll just use the word buy. No, I'm buying futures on soybeans. And if I'm buying futures, I bought the futures position. That's because I think the price of the underlying is going up. So if I bought the futures, that's because I think the price is going up. And if I sold the futures, that means I think the price is going down. Now, like options, we have, I gave you the definition. It's a contract, it's exchange regulated. And the reason that's important is because, if you were doing what are called forwards, that wouldn't be exchange regulated, and you would have a non-standardized negotiated contract where you have to worry about the counterparty. But the point here is definitions and costs. You're either going to be paying money out or bringing money in, and benefits and risk. It's basically, we have speculators, and that's pretty straightforward. I mean, if you think soybeans are going up, you'd buy futures on the soybeans, or if you think oil is going up, you buy oil futures. And so the speculators, remember, are just speculating the price going up or down. But we also have people who are using the futures to hedge. And if you're a hedger, you're coming to the futures market because you're afraid of what's going to happen in the cash market, the spot market later on. What I mean by that, if I'm a soybean farmer and I have beans in the field and I'm worried about the price dropping before I harvest the soybeans, I would short the soybean futures and hope to make up in the contract, sell the futures contract high, hope to buy it back low. And I'm hoping that profit in the futures position will offset my loss in the cash marketplace. The way I think of it, I'm going to do in the futures market today what I'm going to be doing in the cash market later on. If I'm Southwest and I'm worried about the price of jet fuel, I say, okay, well, I'm going to do today in the futures market what I'm going to do later on, which is buying jet fuel. That's oil futures to hedge that. And I would go buy the oil futures. And again, same idea here. As a hedger, I'm hoping that if I'm right and the variable cost of my jet fuel goes up, oil goes up, I'll buy the futures contract low, sell it high, and that will offset, whatever, loss I have in the cash market. Again, one question. Not sure how much time you want to put into that for one question. A definition is, again, just like an option. It's a contract with two parties, somebody who's bought the futures contract, somebody who sold. You're either paying money out or bringing money in. There are going to be costs to implementing either the speculative position or the hedge. There's commissions, there's transaction costs. And then the benefits of the futures are leverage in terms of a speculator and this idea of hedging and offsetting risk. Here in characteristics and risks of alternative investments, two questions. Now, the one that's going to be very high probability on your exam is the ETN. I don't know of any draw of 66 in which you're not going to be asked about exchange traded notes. And the test question about exchange traded notes is they are a debt instrument. People who want to participate in this marketplace say, oh man, an ETF, I want to participate. Boy, but ETFs actually own the underlying physical, things. They own the securities. They're being custodied at like State Street Bank and Trust. And that's not true of the ETN. It's a debt instrument. The financial institution, the sponsor or distributor says, listen, instead of actually owning, the underlying index like they do in an ETF, what if we just promise to give you whatever that underlying does, that index does? So if it's an ETN for $100,000 and at maturity, when the note matures, it's a debt instrument, kind of like a zero, doesn't have any, interest or anything along the way, is 36, then I'm going to write you a check, the financial institution, for $136,000. And so what that means is you have credit risk that the sponsor can't make good on this, right? Credit risk is the risk of default that they don't make good. So you're definitely going to get, of these two questions, one of them is definitely on an ETN. So leverage funds try and do, 2 times or 3 times, whatever the thing they're tracking is. And the way they do that is by using futures again, and using those future contracts. They're going to have to, futures have a term, right? They're going to have to reset, and they may not actually, perform in the way you think. In other words, it calls itself a 2X fund, but it doesn't do 2X or 3X. But again, the main point here again is these are heightened suitability, and they're more trading vehicles than they are long-term investment vehicles. So, we don't know, what the two are going to be here, but you're going to get 2. ETN for sure, ETN for sure. Inverse funds try to go the opposite direction of whatever they're tracking. And again, the way they're doing that is through futures again. And so that means they're going to continually, in these leverage funds and these inverse funds, are going to have to continually rebalance the portfolio, reset using the futures. And again, that means they may or may not be able, because of the reset, to do what it is they're claiming they're going to be able to do. Opposite the index they're tracking. And I'll just put in there, the reset can be problematic. These are structured products. They're not tried and true. It's not like, buying a growth fund or something like that. And so in all of these types of products, these structured products, we certainly are going to have heightened suitability standards, to make sure that, if the rep is, the investment advisor rep is selling this, that they actually understand the product and, comfortable putting it in the customer's portfolio in terms of knowing how it works. Viatical or life settlements is where we package up, buy life insurance policies from people who we know eventually are going to die. And instead of them getting the money, we cash them out, and then the fund will get the money and they'll send you a portion of that. And again, that's considered to be a structured product again, and again, heightened suitability. I haven't had anybody on debrief tell me they've seen anything about those. Now, the insurance products here, you're going to get 3 questions. Let's start with the high probability one. The high probability one, I don't know of any draw in which you're not going to get asked about an equity indexed annuity. I have a pretty spot on practice question on this. Again, this is actually just a explication of the test issue. It's not a lecture. But here it's considered not to be a securities product. And it's not a securities product because your capital is not at risk. So that means you don't have to be licensed to sell securities to do this. And what I mean by it's not a security product is you can't lose your principal, because this is the main point people get hung up on the test. There is no negative reset. So I'll just give you an example. Let's say that it's a $100,000 equity indexed annuity. And let's say the index goes up 20%. 20% is $20,000. And let's say it has an 80% participation rate. So 80% of 20% means the reset at the beginning of the next year is going to be $118,000. Year 2. Year 2, the market goes down 30%. The reset going into year 3 is going to be $118,000. So there's no negative reset. Please, please, please note, ladies and gentlemen, no negative reset. Now, fixed annuity is not a securities product either. In a variable annuity, remember a variable annuity, we're putting the money into a separate account or sub-account, which is a mutual fund. I don't know if it's helpful, but I think this helps get questions right. I think of a variable annuity as a mutual fund with an insurance wrapper. A mutual fund with an insurance wrapper. And that means basically you got to be duly registered to, sell a variable annuity if you want to get a commission on it. And the insurance wrapper is kind of helpful. So what I mean by that is, sometimes we refer to this as a non-qualified retirement plan because you're using after-tax money you've already paid taxes on. So, if you deposit into a variable annuity, I don't know, maybe you're 30 years old, you're a professional athlete, you've maxed out everything else you have, and you give me $1 million after tax. I just made that up. We're going to put that into not the general account of the mutual fund, but a separate account. In the separate account, there'd be sub-accounts. These are mutual funds. And you're going to assume the investment risk. That's not true in an insurance product, a traditional insurance product. And so let's say, I got one too many S's there. So you were 30 years old when we did this, and 29 and a half, 59 and a half. So that's 29 and a half years from now. You call me and say, hey, Dean, how did the sub account do? I said, well, it did pretty well. It's, there's $10 million in there now. So that's that mutual fund, that separate account, sub account. That's what it's grown to. And, one thing they like to do is ask you about the tax consequences of this. So one of the things you could do is you could ask for a lump sum. And so my example, you could say, Dean, send me the entire $10 million. And if I send you the entire $10 million, please recall your cost base was $1 million. Cost base is what you paid for the investment. You paid with this after tax. So you're going to own ordinary income tax rates on $9 million. This is going to be taxed at ordinary income tax rates. That's important because if it was a long term, it might, if you did this, in a security and not this, maybe that would be different. Now, another thing you could do is a random withdrawal. And if you randomly withdraw money, you say, Dean, send me the $1,000 or $1 million I originally put in. I say, nope. If you do random withdrawal, that's going to be LIFO. And that means last money's in, first money's out. So if I send you $1 million on this thing, 59 and a half, and I send you $1 million, it's not going to be the $1 million that you put in originally. It's going to be $1 million of the 9 that you haven't paid taxes on. So that's, not bueno. The other thing you could do is you could annuitize this and turn it into an income stream that you can't outlive, and that's pretty cool. And if you annuitize this, the thing that will give you the largest monthly check is if you tell the insurance company that you just want to be paid for your life and your life only. That would give you the largest check. All right, so we're talking about insurance. We said fixed annuities are not securities products. When you do a fixed annuity, the money goes in the general account, and the insurance company is assuming the investment risk, and you might get some better inflation protection in a variable annuity or an equity indexed annuity than you would get in a fixed. Now we have traditional life insurance. And so traditional life insurance is going to be the term and the whole life. Those are just traditional insurance policies. Traditional. And in, traditional in term, there is no cash value because you're just telling the insurance company, listen, I don't need any cash buildup. Just, tell me how much dollars you're going to pay if I die. And with whole life, there is going to be some cash value buildup, so you're going to have some cash value in this. And term, a whole, and then we have universal life. Now, one test question, you're never supposed to sell insurance as an investment vehicle, but in the universal product and in the variable product, and both those products, embedded into the policy is a mutual fund, a separate account, again, that sub-account idea. And the idea is that you're going to, put this money into there. And in the variable, there's going to be some money going in the variable life. There's going to be some money going into the general account and some going into the, the separate account, the mutual fund. And you're hoping you end up with enough money, in the separate account that it'll sustain the cost of insurance. Now in universal life, so this has a fixed premium. And this has a kind of cool flexible premium. So if you miss your premium, we're just going to take that money out of the separate account. And that means that if we continue to dip into the separate account because you're not making your monthly payment, because you can pay or not pay. And if you don't pay, we just take it out of the separate account. This thing could lapse your insurance coverage due to insufficient cash value. Okay, so as we said, 3 questions on insurance products. One more point about insurance, another test question about traditional insurance here. We're going to have to do test question, a capital needs analysis. So let me get a different color. And that shows up quite a bit as well. So, I say, I have a friend, I'm not an insurance guy. If I tell you need life insurance, you really do, because that's just not something I, talk to people about. But, I was talking to my friend Jim and he said, Dean, I don't like to make a bet with an insurance company, that I have to die to collect. And I said, well, Jim, you're missing the point. It's not really about you. It's about your, wife and your kids and, what are going to be their future needs. And so we're going to do this to determine, what kind of coverage you're going to need in life insurance. How much life insurance you need. To carry out whatever it is you're not going to be here to carry out financially. If you see that, that's shows up, and that's an aim and shoot point and click question. All right, one question on investment real estate and commodities. And again, we kind of know what the thing is going to be here. So it's not up to it. I mean, the precious metal shows up more often than not. But if we invest in real estate, there's a couple ways to do that. But the point is, why are we doing it? And we're doing it to get a different correlation than we get from our financial assets. Again, let me go back and get the different color. And there's several ways to do that: REITs, direct participation programs, whatever. And then commodities and precious metals. Well, by the way, this is also, real estate is also a good inflation hedge, but inflation hedge or purchasing power. And same with commodities. And we're not talking about futures on commodities. We're talking about the physical commodity, whether it be, corn or cocoa or, whatever it happens to be, soybeans, oil, whatever those commodities are. And, it might have a place in an overall portfolio in terms of diversification. And then precious metals and, stupid but testable. Make sure you know that copper is not a precious metal. Gold is a precious metal, silver, titanium, sometimes they like to know, that copper is not a precious metal. Copper is a metal that we use everyday things, plumbing. And again, we would put precious metal into the portfolio, again, as an inflation hedge or to get different correlation than we're going to get from our financial assets. Okay, well, that brings me to our next installment. Our next installment in the playlist in the explication, we liken you to the playlist for the various series. They have narrative lectures. We have 2 narrative lectures for you. More than that, if you need to review things that on your 7, maybe you want to review again, but the 2 would be at the front of the playlist, Uniform Securities Act and investment advisors. And we have a practice final for you. And then we have 50 analytical tool practice questions. And then we have these explications of the test specifications on the 66. And so my next installment will be here Roman numeral 3, 30% of your exam, 30 questions. So hope you're finding these helpful. If you are, like, share, subscribe, tell other 66 test takers. If you're now just finding our channel and finding these resources in your 66, your third leg, please tell people climbing the mountain behind you that are on their SIE and the Series 7 that these resources are available for them. And I'll see you on the next installment of our explication.